recently we actually have token holder governance. So although anyone can propose a market, although we expect token holders to approve any market that's reasonable, that's like not fraudulent and is set up reasonably, there's actually a role for token holders to play and say, no, this is just fraud, or this is just too risky, and everyone will lose money regardless of whether they're directionally right or wrong, because it's going to be too volatile for the amount of margin being taken or whatever. So we do have that sort of built in, because I think it's important to be able to not just present people this huge just pile of stuff and say, work out for yourself what's a scam.
Hi, it's Connor Svensson here, founder and CEO at Web3 Labs. This is a conversation with Barney Mannerings, founder of Vega Protocol. Vega Protocol is a platform for building decentralized derivatives for Web3. In our conversation, we dug into a number of topics, including the infrastructure required to cover on-chain derivatives, how they approach leverage and risk management with Vega Protocol, the community's role in the creation of these assets, and what's still missing from DeFi. Whilst derivatives have been linked in the past with events such as the global financial crisis of 2008, they are absolutely key pieces of plumbing in our financial infrastructure, allowing businesses to hedge risk against a myriad of different asset classes. Barney is a finance and technology veteran who spent many years working in capital markets before founding Vega, and it was exciting to see how they're building out this key infrastructure for Web3. Barney, it's an absolute pleasure to have you here on the podcast.
Yeah, great to be here. Really excited to get into things.
Well, I always love to start these episodes with learning a bit more about people's own journeys with respect to Web3. People have come into it at different times and they've all had different motivations for what brought them in the first place. And so when was it that you first heard about it, and what was it that kind of captured your interest and then ultimately led to you immersing yourself full time in it?
Yeah, I mean, I'm a computer scientist originally, and I've been sort of hanging around the the sort of privacy and cryptography world on the outskirts for a little while. I've always been interested in that stuff, and then Bitcoin originally obviously was pretty interesting, but I guess I didn't really do much. I did back in 2013 or so. I did a little bit of Bitcoin mining, and it was really the sort of emergence of Ethereum and this idea of not just moving money around, which is sort of relatively boring, but this idea of actually creating these kind of decentralized applications and protocols. So it actually moving bits of infrastructure that are currently run by, a bank or an exchange or something like that, moving them on chain so they're completely transparent, so that everyone knows how they work, everyone can see, and this infrastructure is kind of available to everyone was really interesting and exciting to me, because of the possibilities of kind of just democratizing access and allowing anyone to come and innovate and build on things, compared to the closed financial system we have. But also perhaps the idea that that would spark like kind of an innovation wave of different types of things that could be used. So I started to sort of fall down that rabbit hole with Ethereum, and I worked in sort of traditional finance, building trading platforms and stuff. So as the world there started to emerge, it was sort of beginning to get closer and closer to the things I was working on. So that's when I got really interested, was when I started to see those capabilities really.
And so was that when like DeFi started to emerge? Because I know, of course, now what you're focused on is very much so aligned with a part of the DeFi ecosystem. But was that kind of one of those key catalysts there, or was it really before we had the DeFi summer and there was less happening, that you're already seeing those sorts of opportunities?
Yeah, it was a little bit before. So I think DeFi wasn't originally a term. When we first started, we sort of didn't have the word DeFi. We sort of were just thinking about decentralizing the financial system. And for me, I was thinking a lot, there was a lot of talk of the power of Bitcoin, the power of sort of cryptocurrency. And a lot of people were imagining that like moving money onto Bitcoin or onto a blockchain would suddenly change the world of finance. And that on its own doesn't seem to work to me, because the financial system and what happens in finance is mostly about the trading and the products and the access to funds, not necessarily the sort of the model of how the money itself moves. It's just a starting point. You have to have money, but having digital money that's kind of open to everyone doesn't necessarily mean everything else is. So that got really interesting to me. There were some early decentralized exchanges like EtherDelta, And some of them made, I guess quite a lot of what you might say mistakes, in terms of user experience, in terms of actual, the usefulness of the products they were building. So that got me really interested because I could sort of see all this potential, but also see that what was currently there wasn't going to deliver that potential.
And so when did the Vega protocol emerge from all of this? Because I understand you've been working on it since 2018. But what was kind of that catalyst? Because there's one thing, having security of like a TradFi job and dabbling in this stuff around the edges, and then there's the other, which is when you've got that conviction and you kind of you went all in, so to speak, with it.
Yeah, that was as you said, 2018. Ramsey, my co-founder, and I had been talking through 2017 about a lot of these ideas. We'd been meeting with people, talking about like sort of my early designs for how it would work. And I had a previous startup that I'd been running with my co-founder there, Ed, and he's now one of the founding team at Vega. And we were sort of trying to work out what to do next. I think we sort of realized that had run its course. And Ramsey and I had been talking more and more and thinking about these things, and we started running these ideas past some really clever sort of cryptographers and academics and researchers we know in the Web3 decentralized space, and the guys who end up founding Chainspace and end up getting exited to Facebook and all of that. And those guys are sort of super smart in those areas. And we started to realize that this sort of idea for a design made sense and was possible. And then, in early 2018, we started to pull together a team, write the white paper, and then, started on the journey to fundraising a seed round, which we did in 2019.
And so you mentioned how you'd been looking at like the DEXs that were available in those sort of earlier times. So what was it that made you focus on the derivatives market? Because of course, given that it's whilst the DEXs have been around for a little while, there's still, I guess, a lot. But going back 4 years ago, whilst they existed, there was a lot less awareness of them. You didn't have anything like as many integrated services there. And no doubt there was an opportunity, of course, for thinking in terms of derivatives, but there's probably some people who would have said it was putting the cart before the horse, so to speak, in terms of focusing on that at that stage. Now, I'm sure, given where you guys are now, it was definitely a good area to double down on, but it must have taken quite a lot of conviction back then.
Yeah, I mean, I thought people would move faster on spot DEXs. So I sort of figured that there were spot DEXs like EtherDelta, like I said, and Bancor with this sort of AMM stuff. And they took a bit longer to turn into sort of really viable products with a lot of users than I expected. And I'd sort of thought that it would not be viable to try and start a thing from scratch and fix spot DEXs without incurring a lot of competition from people who would probably have a lot of users by then, especially with the kind of goals we had for performance and the things that involved us building our entire own sort of blockchain rather than piggybacking on something slower like Ethereum. So I kind of probably overestimated how fast that would all move, because I actually think building derivatives is harder than building a spot DEX. And actually looking at the timelines and where we were and when we could have launched a spot DEX, if that had been our focus from day one, I think actually that probably would have worked, and then we could have moved into derivatives. But nonetheless, I have quite a lot of experience building derivatives trading platforms. They're an interesting topic. There's kind of a bit more of a knowledge moat, if you like, a skills moat in terms of how much you need to know and do to get derivatives working. And it was an interesting and sort of bigger challenge. So all of those things fed in. I think eventually I would have wanted to build something more than just a spot trading platform. It really was about these sort of products and derivatives. But I do think, looking back, the spot DEXs moved slower than we expected, and so there probably would have been an opportunity to launch spot. But at the time, it looked to me like that was going to get done pretty quickly, and the next race would be derivatives.
And so, to go into a bit more detail with Vega, I'm just very interested to scratch beneath the surface a bit more in terms of the components and the building blocks and so on. You mentioned that you're using your own chain there. It would be great to sort of unpack some of the motivations there, and also maybe talk through I guess one of the more some simple derivative type products that you have on the platform, and how that works, because of course the derivatives landscape is absolutely huge. It's far bigger than, I guess, the equity markets and so on, in terms of the notional values of these things. And so what are kind of some of these key building blocks there that you've had to build out and think about? Because doing this in TradFi, as you said, is something you knew, but in the decentralized world is very different. And so I'd love to get into those details.
Yeah. So in fact, one of the interesting things is the decentralized world is both different and sort of the same, in that a lot of the same problems and motivations occur. So, if you're a trader, you're interested in having low fees and having predictable fees and costs for trading, so total cost per trade or whatever being low. You're interested in high capital efficiency. So the idea that, if I'm taking out a margin product, that I need as little margin as possible so I can make the best use of my capital, and performance, so that your price determination and your orders get processed quickly. And what we realized when we looked at things like Ethereum was that they were really bad for all of those sorts of reasons. The fees on Ethereum are kind of an auction, where you're sort of buying space on the blockchain against everyone else who wants to use it. And sometimes those are people who want to buy CryptoKitties or Bored Apes or something like that. So you get these incredible spikes in the fee cost. And the fees are also very high compared to the fees of using an exchange. So we sort of see that because Ethereum has this kind of contested, rare block space, where actually what we really want is a system with nearly unlimited block space. Actually you want to be able to scale horizontally, so like maybe actually there's effectively what looks like a separate chain almost per market, even if needed, so you can actually add more markets without just pushing up the price of the fees everywhere. You want the fees to be predictable, so ideally like some percentage of the trade notional, and you want as much performance as possible and quick finality. So in Ethereum, you need to wait, say, 50 blocks to know you're certain that your transaction's gone through. The block is 13 or 14 seconds. That's quite a long time. Whereas on Vega, as we designed it, there's a sort of 1 to 2 second block time target where you instantly know after that your transaction's gone through. So we were just looking at all those problems and realized that the only way to properly solve for them was to build a bespoke system. And then I thought back into the world of trading. There's a lot of technology gets built using standardized systems, WordPress and things like that, but never seen a trading platform built on WordPress. And I realized that the same thing is true on blockchains. Like Ethereum is the WordPress. Everything generic and standard can go on Ethereum, but actually when you start talking about the amounts of money that exist in trading and derivatives, then it makes a lot of sense with that much money and that much at stake to build a system that's optimized, that's going to minimize the fees, going to maximize the capital efficiency, because that much value is available yet to be had by doing that.
And does running your own chain though in that regard add quite a lot of overhead? I mean, certainly the landscape now is quite different. Especially last year, we had all of the different alt layer ones emerge. Certainly Solana, for instance, it's the team there have always spoken about it as being, well, when they created anyway, they were thinking more about it as there for financial plumbing, more akin to some of these traditional financial platforms. And so do you think if you had what you had now, you'd still go down that route?
I think so. I mean, I think probably Algorand is another good example, as well as Solana, who are trying to be very financial focused. And they have started from the point of view of building a general purpose blockchain that can do everything and trying to build financial use cases on top of it. And what we've sort of done is started with more like a kind of, I guess, an MVP approach to that, and said, we're going to build a blockchain that can really only do, even a subset of our intended future target financial use cases. And we're going to make it as good at that as we can. And then we're going to iterate it to include more features. And to me, that seems like the better way to do this, like to assume all these features and all these capabilities that may never get used, but also to kind of leave it to the other builders to deal with things like, sort of how the order books work or how risk is managed, and to have to deal with whatever constraints you put in place when you built your chain. It's going to make, I think it makes innovation harder, and it makes hitting the kind of goals and targets a little bit harder. So I think the way we do it with the app specific chain makes a lot of sense to me. Whether or not we'd use a different, we're built on top of Tendermint, which is the consensus layer that's used in Cosmos. So we actually didn't just build everything from scratch ourselves. We have taken libraries and code libraries and things where we can. Whether or not, if you were doing the analysis of Tendermint versus every one of those other potential bits of open source code right now, whether or not you'd pick exactly the same base like consensus layer, I don't know. We haven't had the time to redo the analysis because it's sort of we're down this road now, and Tendermint is working well for us. But whether or not there'd be something else that you might pick if you were doing that analysis today, I don't know. But I think building an app specific chain and starting there and growing out the features with the network rather than sort of the other way around makes sense to me.
And so then digging into some of the actual derivative type products, which I guess broadly speaking, derivatives tends to be made up of futures and options are some of the, I guess, the best known types. But how would, if you were to talk through like an example derivative on the platform, what would it be for? What sort of asset would be the underlying? Who would be creating that, and so on and so forth?
Yeah. So the goal eventually is that the platform is designed as kind of this sort of framework or this layer, which has the ability to do the settlement. It has the ability to effectively call out to risk models to manage risk and margin, and to have those models be calibrated for each appropriate market, so that effectively you can trade any type of derivative, and as long as you have the right sort of risk model and information that you need. So that's the sort of long-term future. Initially, we're starting with like the simplest thing we can. So even though we didn't start with spot, we're starting with the next simplest thing, which is cash settled futures, which means that effectively you can have a price for pretty much anything. You can trade it with leverage and margin, and effectively how that works is the settlement happens in a crypto asset. So Vega is actually bridged to Ethereum. So even though we didn't use Ethereum for our base layer, we're a bit like an Ethereum scaling layer for derivatives, in that, similar to the L2s, you basically connect your Ethereum wallet, send your ERC20 tokens from the Ethereum network to your Vega wallet via a bridge that we've built, and then you trade on Vega with all of the sort of performance and cost and other advantages of Vega. And then when you're done, you sort of withdraw them back to the sort of main Ethereum L1. So, we use those Ethereum assets to settle. So an example could be, say, a Bitcoin futures contract which settles in USDC or DAI. And that product effectively is a cash settled future product that's built into the Vega system, a sort of log normal risk model that you configure with the appropriate risk parameters based on the sort of the volatility or expected volatility of the market, and then that then creates a market on Vega that everyone can trade on, and that's one example. But really, the only important thing is that you need to have a price source for settlement. So obviously the market uses an order book. We have a liquidity protocol that effectively incentivizes people to provide liquidity. And then at the maturity of the market, effectively there's an oracle or a data source for the settlement. And that's the main thing. So as long as you have that data source, and that could be, an entity who's trusted, who's willing to sign a message and send it to the network and say, I know we're Goldman Sachs or we're whoever, and we say the price is this at the maturity date, and so you can settle on that. Or in future also we'll allow connectivity via our Ethereum bridge to kind of decentralized Ethereum-based sort of smart contract oracles. So really that's going to be the main thing. But once you can get a data source, you can do the price of pretty much anything that you can get the price for. You can do weather derivatives, you can do commodities, you can do cryptocurrencies, you can do FX. As I said, initially cash settled.
And do you think that people will longer term they'll care a lot about the which oracles are being used, because of like you have saying the I guess the Web3 world Chainlink being one of the main best known oracle provider anyway. There are certainly others, but then as you've mentioned there, you could have existing financial institutions as well, kind of providing that side of it. Where do you think it will head? Do you think there'll be like one or two dominant providers there, or people will actually be quite, I guess, picky about wanting to ensure that certain derivatives are linked with, say, maybe more trusted existing financial institutions?
I mean, I think one of the things that it's important not to do is like fetishize decentralization. And for finance, a lot of the time there is sort of a primary source. Like if you have a stock that's listed on the London Stock Exchange and you want to know the price, asking a group of decentralized people to vote on the price or whatever via a protocol like Chainlink or something doesn't make a lot of sense to me, because it seemed to be a lot simpler to just persuade the London Stock Exchange to sign a message and say the price at the end of the day was this, because they are the place where it's listed. So I do think that in finance, one thing you will see is a lot more, a lot more situations where there is simply a good source of the price, and people just plumb up to them, wire things together, and you just say this is the source because these are the people who basically have the primary market. I think people will care. I think it'll be a bit like payments on the internet. When the internet was new and online shopping was new, everyone was super worried about security of payments and not putting their credit card in case someone stole it. And eventually we kind of got more secure HTTP. We got kind of used to the way things work. We got providers like Stripe, and people want to know that their money is secure, but it's mostly a solved problem now. You go online, you have different ways to spend money, and you don't have to think about it too much. And I think this will basically happen with the oracles. Like, for the next year or two, we're probably going to be in a sort of phase of rapid building where people are trying to ensure security and solve the problems and find the right solutions. And then at a certain point, we'll just realize that we've kind of got good systems at work that are verifying these things, good ways of using governance on chain, on protocols, with DAOs, whatever, to to maintain these things as good connections and to deal with issues when an oracle goes wrong. Vega has a protocol, governance protocol, that can be used to change the oracle source for a market if there is some issue with a provider. So I think it'll become a solved problem, but I think it's important that people pay attention to it and make sure we do solve it well, because it's obviously kind of the weak point for attacks. If you can influence and disrupt and corrupt the oracle for the settlement of a market, then you can obviously do quite a bit of damage.
But it's a very interesting point that you raised there with respect to these established firms getting involved in externalizing some of this information to Web3 is a very good business opportunity for them, whilst like a single asset price or something along those lines from an exchange in isolation may not seem so significant. If you can start recording all of these facts that these institutions are the best qualified to, and putting them on a ledger there, it's where ultimately this technology will head, and it's probably something that not enough of them are engaging with at this point in time, which is a nice way for them to dip their toe into the Web3 water, so to speak.
Yeah, I think so. And one thing we thought a lot about, and we haven't come to any final conclusions yet, is like, how does the sort of financial side of this work? I think the blockchain world is very used to everything being public and open source and available to everyone, and that does sort of rub up against a traditional provider who might expect to be paid for that data. It may be that you find the market creators and the market makers who are profiting from a market, like maybe that they just sort of directly license the data in order to do the settlement, or it may be that we need to design things on chain in protocols like Vega so that actually, when you create a market, you can set up an address that belongs to the Oracle provider, and actually, the same address as the Oracle. Maybe you could have the market send them 0.5% of the fees or something like that. So effectively, there's a kickback to the provider of the data, that as every time people trade on that market, they're receiving something. So I'm not quite sure how that's going to pan out or what the best way to do that is, but I think it's important to make sure that the incentives in the system are aligned so that people who have that good quality data have an incentive to provide it.
And I know that one of the areas you're very keen on is the permissionless nature of these Web3 networks. And so how does that kind of factor in with respect to Vega? Because no doubt it lowers the barriers to entry in terms of anyone can participate in the network, presumably.
Yeah, and I think the thing that I noticed with the internet was you sort of went from this world with a small number of like large companies producing entertainment, producing journalism, distributing it. Like, you're sort of in this world of most people are takers of this stuff, and it's kind of very sort of planned and very commercial in a way. And the world now, and obviously on the internet, is still pretty commercial, but the way the incentives work and the way people get involved, whether it's journalism or whether it's things like YouTube and Instagram and media content, is now that an individual person can create and profit from building a YouTube channel and building their own online identity in a way that would never have happened before the internet. And I think that's super exciting because it's just created this huge wealth of content. And I think the same thing can happen for finance. Right now, you talk to traders or you talk to people in the marketplace who are looking for products for hedging or something, and you find that actually, they're trying to hedge some risk they've got. And, the the best hedge they've got is actually for a product that's actually slightly different, and the dates on the contracts don't actually align with the cyclical seasonal nature of the market they're trying to hedge or whatever. And so they're kind of constructing these hedges and doing their best to manage risk, but they've got like a product that isn't perfect. And the ability for people in the marketplace to see that opportunity, and perhaps one or two or three people who see that opportunity to almost practically in their bedroom start a product, build a product, find liquidity and potentially make money out of doing so, because this infrastructure layer that's sort of shared on the blockchain gives them, high quality, dependable primitives, which they can then compose together to build this business. I think that's super exciting. And so I sort of expect to see a massive increase in the amount and innovation and variety of different markets and different products that people can trade. We've already seen loads and loads of interesting experiments going on in Ethereum, and that's as I mentioned, a chain that's quite slow and is quite limited in terms of what you can actually build. Where you often got major constraints. Whereas I think once we see platforms like Vega, where people can really, and much more simply than Ethereum, because we provide such sort of rich basics, rich primitives, where people can quickly pull together products of different types and with different sort of payoffs. I think we'll see a huge amount of innovation and a huge amount of sort of rapid iteration of the sort of the financial system in a way.
To unpack that point a bit further, thinking in terms of for someone who has, as you said, like a specific derivative that they'd like, I guess in the Vega sort of approach is that they could engage with other members of the community. If they can't see something there, then they could say, hey, we'd be looking for a future with this expiry with this specific asset. Say, is someone willing to actually create one for us? And is that kind of how you would pan out ideally?
Yeah, I think so. And it depends on your level of your level of expertise in different areas. Like if you're a fund and you've got the money, then you can also you can build the market, become a liquidity provider, and obviously providing liquidity is a profitable activity anyway. So if you're a fund, then maybe you do it one way. If you're more of a participant, then perhaps you join together on maybe even your own industry forums or conferences, and then in the Vega community and on the Vega forums, and actually start talking to people and saying, well, we have this need for this kind of product. How big is that need out there? How many people want this? And if you start seeing tens or hundreds of traders upvoting this and people talking about it on Twitter and saying, actually, this would be really great for this particular industry to have this product, then you can imagine that someone who was paying attention and working for one of these sort of liquidity providing funds would see the opportunity there. And Vega is very much designed so that it has incentives for liquidity provision. You basically share in the fees on the market. And the way that sort of share of fees is calculated is actually based on growth as well. So if you provide liquidity and commit liquidity early on in a market's life, then the amount of the fee revenue that goes to you as opposed to someone else committing the same amount of liquidity later is higher. So it's a bit like being a seed investor versus a Series A investor. You're kind of getting in early and taking the risk to create the market, has a beneficial payoff if the market's successful. And the idea there is that means that there will be some types of market makers will want to play it safe and get involved with established markets, whereas others will be more likely to be interested in understanding where the demand is and spinning up markets that are perhaps a bit more sort of speculative in terms of how much demand there is, but when they do pay off, they're going to pay off very well for those people who created them. So I think that's kind of the dynamic we're looking for, and what we're hoping to see is a sort of a rich community of people collaborating in that way.
And then to kind of, I guess, go into some of what would be the Web3 kind of centric approach here to these on-chain assets. Like, for instance, within DeFi lending protocols, they've of course gained a lot of traction in the last few years, but we're kind of stuck in this place right now with Web3 where the lending is fully collateralized. You don't really have a way to do sort of partially collateralized lending in the same way, or have the almost assess the credit worthiness of potential borrowers. Within the derivative space, of course, there's people can take on a lot of leverage. So there's getting the risk management right is very important. So how do these kind of things work? Because in the centralized world, of course, there's people have to post collateral, or there's margin. They have in effect credit with these different institutions, but in a permissionless world, it is quite different there.
It's similar but different. And with there's been some good coverage recently because FTX have actually been trying to create like these sort of continuously margined centralized markets in the traditional world, and that's very different. The traditional world sort of works where you get given an initial margin requirement, you post that margin, maybe a week later, maybe someone calls you up or sends you an email and says, by the end of the day, we need you to post this much more margin. Otherwise, we'll close your position, and maybe you call them back and say, actually, I'm on a train, I'll post it tomorrow. And they say, sure, that's fine. And the reason that works is partly because the amount of margins are good, and partly because they understand the credit worthiness of the people they're dealing with, and they have contractual relationships. They can go after them in court if they don't pay and all of that. In the crypto world, we can't do that. In the Web3 world, we're really stuck with people put margin on the system. We can hold that margin, but if they don't pay more, they can run away. They're just a key. That's less of a problem than you might think, because with derivatives, what we can do is we can actually recalculate the margin requirements based on the volatility we're seeing really regularly. So effectively, the amount of money I need from you depends on how volatile the asset is, and it depends on how often I can get more money from you. So if I effectively am directly kind of connected to your account and can get more money from you, once a minute, once a second, whatever, if we need more margin, and can instantly close out your position, basically just, if you're long, we just sell in the market and close out the position. If we can do that really quickly, then effectively we can cope without being able to have those other benefits that exist in the centralized world. So actually, the amount of leverage you can get with a system like Vega is pretty similar, perhaps even in some cases more than you could give in the sort of traditional finance world, because of that sort of more real-time situation. There are some differences. One is that in the more real-time situation, there's less sort of margin for interpretation. You can't phone someone up and say, well, I can't actually fund my account anymore because I'm on a train. Can we just do that tomorrow? Your position is going to get automatically closed by the protocol. And so, that's a potential disadvantage. Although whenever there's a crisis or a downturn, those people who were given an extra day and still default have put their bank more at risk. So, there's both positives and negatives there. But, to your other point, I think one of the interesting things is that without sort of a reputation system and without ways to do something more like the traditional system, that does limit what can be done. So, very bespoke products where you're sort of doing an over-the-counter deal for a bespoke structured derivative or something, that's only going to work if you can actually have someone warehousing the risk and someone assessing the credit worthiness of their counterparty. So, there will be a need, I think, eventually for the sort of crypto financial system to gain protocols or ways of tapping into things like information about credit worthiness or reputation, and even eventually, you may well find that many participants choose to reveal who they are to the people they're dealing with in order to get, say, better terms or better credit. But I think that's still some way off with the crypto world, but we can get quite a long way, at least with fairly liquid markets, with the kind of just by doing very real time evaluation of margin.
Do you believe that whilst there are, of course, privacy constraints here, not all organizations want everything to be happening on public chains, but do you believe that much of our existing financial infrastructure will end up on chain? It might be a private permission chain, or whether it's like a chain that uses some privacy technology on top of it that's public. Do you see that that's kind of inevitable? Certainly, I see from a regulatory perspective, it makes a lot of sense if regulators can, rather than relying on reports from all these different separate institutions, can easily just go and aggregate this information they want in real time. But I'd love to hear your opinion on it.
I think it makes a lot of sense. I mean, I think certainly when I worked back in the sort of traditional finance world, we would often come across these problems which were very difficult to solve. You sort of have things like settlement systems that cost billions of dollars a year to run, are incredibly expensive to maintain, very difficult to add new features to. Some of them still run on COBOL, many of them do. And you often get banks who will get together and say, well, why don't 10 banks build a settlement utility? but these things always fall apart because of arguments over who owns it or who's in first or how much money they're putting in or whatever. And I sort of think there's a lot of the financial infrastructure which is boring. It's not actually it's not a source of income or revenue or competitive advantage. It's just stuff that has to be done. And regulatory reporting is one of them. Settlement is another. And actually, when you talk to to front office guys and traders and people who run that side of the business, they're kind of like, if we could get rid of half of IT because there is shared infrastructure that happens on a blockchain, and we're mostly just a front office and a risk management function, we'd be super happy because we're spending so much money on building this infrastructure that's not non-differentiated. So I sort of see it as a bit inevitable. I think the point you made around privacy is probably, and privacy and performance are probably the main things. Getting the performance and the sort of robustness of these systems to be proven is going to be one thing, and then getting the privacy right. I think there's definitely a lot of room for, in the future, the kind of technology that sits behind things like Zcash and Monero to get more wide adoption and to come into DeFi, so you have more privacy by default on transactions and protocols. And I think that's something that the whole industry needs to focus on and do. And then maybe in the interim, for some of the big institutional stuff, you'll get these kind of more permissioned blockchains where things are private or between a small group, or even actually it's easier to create privacy even individually, perhaps if you know who everyone is and it's a small group, than it is to do it in a general sort of public permission chain way as well. So I think the privacy thing does need to be solved eventually for real serious large amounts of stuff to be moved and for certain things to happen. But I do sort of think, at least for some aspects of financial infrastructure, it's quite inevitable, and perhaps for the sort of the boring parts, but also that back to that permissionless innovation point, you might find that startups and small markets emerge from blockchain technology and then become large enough that they sort of become institutionalized. And the hope is that in the long term that these blockchain systems with the right privacy can actually replace the gatekeeper institutions, but for a while they may work alongside and be kind of a feeder of new markets and new products.
And I should definitely highlight as well what it says on your T-shirt too there. Privacy is a human right, for people who aren't watching a video of this. So it's I think that kind of sums up the importance of this stuff as well. It's been a lot happening in the last week or so, but this was probably not the thing to discuss today. So just thinking more about the overall DeFi landscape, because what we see is these different components being built, which are kind of they are analogous to what exists in TradFi, albeit with different attributes in terms of they're accessible to all. They're on these permissionless platforms. The barriers to entry are a lot lower to it, and of course we have things like stable coins. We have the DEXs as well. We have lending protocols. We have derivative platforms. You mentioned earlier too about the need for more in terms of credit and reputations scoring. So when I spoke with the guest previously, they were talking about protocol solvency as well, which I think is another very important area longer term anyway for being able to assess DeFi protocols. But are there other things beyond these that kind of are on your bucket list of things that you see as being like really key to kind of still solve with respect to DeFi?
I think a lot of it is about UX and getting closer to real life, if that makes sense. So I think the UX of wallets is still not great, and wallets are still sort of adjacent to finance. It's very difficult to move between traditional banking and credit cards and crypto wallets. There are some crypto exchanges and protocols that have started to issue like credit cards and stuff now. But I think we're still a little way off of having the UX that people are used to, of kind of like banking and apps and stuff being available, or things being as easy in Web3 as they are in sort of other parts of the world. And I think that sort of holds back adoption. And I think then making this stuff really useful. So, right now we've kind of had a lot of experiments, a lot of kind of trading and speculation, even gambling going on within the crypto world. And in a way that's helpful. It sort of proves out that these things work and are potentially viable. But when you look at the sort of traditional world of finance, what people use these products for, they take out a mortgage to buy a house, or they store money in a way that it actually should be safe enough for storing for retirement, and not kind of like we promise you this much return every year, but here's a real proper analysis of the risks of this protocol, and you could put some money in. I think things like compound treasury are starting to get there with that side of things. And then there's things like hedging products. Obviously, with Vega, we're looking at things like hedging currency risk or hedging the price of fuel or something like that. And actually, what we really want to see is people connect that all together so that you could have a product, say on Vega, that actually hedges the price of, let's say, fuel, and then that could be offered to people in a very simple interface that was usable by a small business owner who was actually exposed to that price and that risk, and that actually they can come and use this thing as an alternative to phoning up a commercial banker, getting probably shafted on the fees and the spread, and taking out a product that way. So we sort of think what I really want to see is getting that point of usefulness across and getting it to a point where people are actually starting to use these products from outside the crypto world because they're actually the best solution for a real problem they have.
Mm. Yeah, and I've certainly thought about how that almost like Google came and organized a lot of the information with respect to the web and web pages. And I believe that there's going to be an opportunity for something similar for DeFi protocols, whereby you can find, if you have specific constraints, as you say, there, or specific product you're searching for, you have a way to easily locate it, but there's degree of trust in there too. So you know that if you sign up to use this specific protocol, or say this derivative that's offered on Vega, it's one you can trust. It's not some shyster who's just trying to make a quick buck and prey on the innocent there. So it's really interesting to see how it pans out.
Yeah, exactly. And Vega's done, if you look at things like Uniswap, they allow you to create literally anything, and they do. I think they control what they show through their front end, but actually, if you know the address, you can trade anything and you can link people to it. So you get a lot of sort of scam markets on Uniswap that are pretending to be, Bitcoin, US dollar, or whatever it is, but actually are just a fake token. Vega works slightly differently. We actually have token holder governance. So although anyone can propose a market, and although we expect token holders to approve any market that's reasonable, that's like not fraudulent and is set up reasonably, there's actually a role for token holders to play and say, no, this is just fraud, or this is just too risky, and everyone will lose money regardless of whether they're directionally right or wrong, because it's going to be too volatile for the amount of margin being taken or whatever. So we do have that sort of built in, because I think it's important to be able to not just present people this huge just pile of stuff and say, work out for yourself what's a scam. And then I think people like Gauntlet and others who are starting to, and some of the people building these like dashboards like June Analytics and stuff, who are starting to get to the bottom of risk and data and actually present back to people information and to help make governance decisions that will reduce the risk and increase people's ability to make good decisions. So I think seeing all that stuff evolve and getting to a point where people can actually find, like you say, a source of products that do what they want, but also where they have an amount of ability to trust that product or trust that market, even though it's built on a decentralized system.
Yeah, absolutely. And hearing about the governance angle that you have there as well, it's certainly something that I think there'd be a lot of protocols and projects that would benefit from having those sorts of, I guess, barriers in place to protect ultimately the end users there as well. So would hopefully reduce the number of bad actors in the systems.
Absolutely, and I think there's one thing to, there are many ways to decentralize something, but one of the problems is when you put on top of people who don't have the expertise a problem which they might not, which might be very opaque to them. So, with some of this risk, the people who are going to be potentially using these products, even let's say they're using them for commercial reasons to hedge, they don't really understand the risk. When they buy a hedging product from a bank, they are expecting that the bank only sells them a kind of suitable product that's actually useful for their need and makes sense. And putting onto them, there might be a small business owner who's hedging something because they were really trying to avoid a financial cost. Putting onto them a lot of arcane financial and technical understanding is probably, in the long run, is not good for the space, and it is unfair to them. So I think, we have to take a bit of responsibility as protocol designers and user interface designers and as an industry for, like, how do we get the information to people so that eventually we can build up a kind of portfolio of products and protocols and services that people actually can trust.
Yeah, absolutely. And so just steering it back to where you guys are now, I understand that you have a restricted mainnet currently, but you'll be opening up the mainnet in the not too distant future. What's kind of the key milestones coming up?
Yeah, so the restricted mainnet effectively, because as we sort of talked about earlier, we're launching both a new chain and the ability to create these markets and products. We wanted to de-risk that launch, so we've launched the blockchain itself and the governance protocol and the staking. We launched that last year, and we've been iterating and working and learning how that works and making sure we improve on things like security and robustness and fragility to make sure that things are in as good a place as they can be. We've got another release sort of coming up very soon in the next probably 6 to 8 weeks, and that release will basically be the sort of final set of fixes and changes that go in before we think it makes sense for people to start creating markets and trading on the network. At the moment, the market creation features are all currently available in the network, but they're actually switched off by our governance vote effectively. So the ability to actually create markets and use those features is turned off, and that's controlled by the token holders. Over Once that release in sort of 6 to 8 weeks comes in and goes through and gets actually put into mainnet by the validators, then effectively there'll be a governance vote proposed on chain, and everyone who owns tokens will be able to vote. And if they believe us and have looked at the code and sort of think this is in a good state, then hopefully that governance vote will pass, and then people in the community will be able to start creating those markets. So that's really the big one to look out for. And just another little probably tidbit that's coming just before that, we're going to run a series of things we're calling the mainnet simulations, and we're basically bringing together community members from market makers to traders, etc., in a sort of more intense version of the incentivized testnet, where we'll be basically simulating as close as possible real kind of mainnet production environment, and seeing how things perform there. So that'll be coming up in probably 2 to 4 weeks time.
No. That's, I think, a natural place for us to wrap up there. With respect to then, if people want to engage with Vega, there's of course the website which is just vega.xyz. But what would be your kind of call to action for people?
I'd say get involved, try things out. We're always sort of looking for people to participate, provide feedback. If you're interested in that kind of stuff, from the website you can find the testnet and you can get involved and even earn Vega rewards for participating in that testing and in those mainnet simulations. And then otherwise, watch out on our socials on Discord or Twitter for what's coming up. There'll be more and more content and more information about how to get involved as the launch of trading on mainnet comes up. And then, pay attention to the launch on mainnet. If it suits you and makes sense, to get involved and actually try it out when the trading hits mainnet, that'll be fantastic. But even just using things, providing feedback, getting involved in the community, all very welcome and all very exciting times.
Yeah, and no doubt a good point to get involved as well, because you're still sort of relatively early in I guess in the life of where you are versus where you will be soon.
Exactly, and all all the opportunities to create markets and to be involved early in the creation of stuff on Vega are really just about to get started. So really, it's for us, it's the culmination of a few years' work, but also the very beginning. And for the community, I think it's really kind of like the starting blocks and the starting gun as we get ready to launch trading on mainnet.
Well, Barney, it's been an absolute pleasure to talk to you today, and really fascinating to learn more about Vega as well. I think it's certainly a key piece of infrastructure that's needed within DeFi, and it's just great to see all of the progress you guys are making.
Awesome. Well, yeah, thanks for having me on the podcast. It's been great to chat to you.
Okay, thanks, Barney.
Cheers. Thanks, Connor.
Hi, it's Connor Svensson here again. I hope you enjoyed this episode. I'm really excited to share with you that I've written a book, The Blockchain Innovator's Handbook, a leader's guide to understanding, adopting and succeeding with this disruptive technology. I've been wanting to share my learnings about blockchain and Web3 for a number of years with a wider audience, and I'm really excited that I can do this now. This book covers everything from the fundamentals of the technology through to opportunity identification and implementation for your business to ensure that you can be one of the big beneficiaries of the wider transition to Web3 that's taking place now. The book is available in physical as well as digital form. For more information, head to web3labs.com/innovators.